Hi, good afternoon. My name is Suan. I'm a partner with Norton Fulbright, Singapore. Thank you, Marine Money, for letting me moderate this panel. And to everyone who is still in this room, well, congratulations for making it till the last session of the day. I can see half the room has walked out. So I promise that this panel will be hopefully exciting. Before I begin, I like to set the scene for today's topic. So bank finance remains the backbone of of shipping, and I mean, it is the strongest people with the strongest balance sheets today that actually remain bankable. But the ground beneath us is shaking, I would say. Competition is pretty intense between the banks, even between the banks here. And Basel IV capital requirements and decarbonization sort of requirements, they are really reshaping the way banks think. They are reshaping how deals are being priced. They're also reshaping the covenants that go into a ship finance document. So the question today really is no longer how the rules are changing, but rather how quickly the rules are changing and who will adapt the best. And so today we'll explore how these global banks, they will recalibrate their appetite in this market, how they are looking at risk models, how they are looking at structures going forwards. And we will discuss the two big topics, Basel and decarbonization. And hopefully they will tell us where opportunities lie, what they are really thinking, and whether Asia, Asia being a real powerhouse in ship finance, will continue to be a magnet for capital in this market. So by the end, I hope that my panelists will leave you with a clear playbook of what goes on in their minds, the anatomy of the ship financier banker. So let's dive in. I'd like to invite Pallavi to kick off this session. The theme of this year's Marine Money is headwinds on all fronts. I mean, there's a lot of headwinds. We've heard a lot of it in the last 2 days. We've got the economic headwinds, we've got the geopolitical headwinds, and then you got the asset price volatility. And then you throw in this whole bucket of new headwinds, the regulatory and environmental headwinds. Basel IV really is influencing the landscape of today's ship financing. And credit committees today are reassessing how they think when they are starting to do a deal, and the terms on which they are going to land on. So can you explain how Basel IV affects your bank's approach to ship finance?
Sure, thanks, Suan. My name is Pallavi. I work with Standard Chartered Bank. I want to caveat saying that as we are talking about Basel IV or Basel 3.1, whichever you call it, a lot of it is still in motion. Not everyone has kind of bedded it down on how we are going to approach it, because there are conversations going on with the regulator, etc. So we are all in that state of, setting up new strategies, setting up the policies, having a bit of back and forth with the regulator, feedback ongoing, etc. But yeah, sessions like these are definitely helpful because we also realize what other banks are doing. So the most critical part here is that what Basel 3.1 does is all the banks, or most of the banks who are using very sophisticated internal rating scorecards and the way to grade a transaction. And that is very important because it's one of those criteria which goes in to kind of evaluate what is the risk-weighted assets that we will have on a loan that is being set out, and the pricing, etc., is determined by this whole equation, right? So depending on where we land on what model each of the banks use, it doesn't matter which model will get approved. Either which ways, the RWA is going to go up. So from our perspective, it's very clear that the banks will have to get stricter with the capital allocation that happens, right? And then, as Suan said, there's an added angle of decarbonization also that comes in. Just speaking from Standard Chartered's perspective, we typically look at any transaction not as just one transaction, but it's a client-led strategy. What that means is you have a lending book, you have other parts of the bank which are doing different kind of products with the client, and we tend to look at it in a holistic way. Of course, there will be lending products which will have higher capital allocation, and it'll have to be kind of assessed, credit committee that Suan talked about will assess, what kind of structures we are doing, and as we get into a conversation, we will get into, what can be done to make this slightly more palatable for the banks as well. But from our perspective, it's very clear, and we've started building this already with the whole ESG thing going. For the past couple of years, we've signed up. We were, I think, the 21st or 22nd bank to sign up for Poseidon Principles. So ESG transition is something that we take into picture. We now look at structuring of a transaction. Is this an SPV transaction that kind of gives us slightly more capital leeway? So those conversations have started. Some of them have been implemented. The short of this whole ramble is essentially that it does not mean that financing is not going to be available after Basel 3.1 comes in. It's just that the lenders will get a lot more disciplined and will ensure that the capital that's getting allocated is going in the right pocket that the bank directionally wants to go.
Okay, I'd like to right-click on what you said earlier. I mean, Basel IV definitely, has stricter sort of requirements, and then it makes probably things a little bit more expensive in terms of pricing. But I would like to move to TC, because whatever that Pallavi has said seems to be quite a similar narrative to what we heard last year. In last year's Marine Money, on the same topic, on Basel, you said that you were looking forward to Basel IV because it would level the playing field, and banks standardizing the way things are done. Do you think that the field has leveled, or then do you agree with the statement this year?
Thank you, Suan. Hi, good afternoon, everyone. Thank you for having me. Yes, I did say that last year, and that indeed is what Basel IV is meant to do, is to level the playing field. Especially in Europe, many banks have been using internal risk models, and the whole idea of Basel IV or CRR3 is really to reduce that reliance on these internal risk models and to standardize, again, the way banks calculate this. And I also agree with fellow panelists that the implementation really has just started. Different regulators, have different timelines, on top of which different banks have different interpretations of these guidelines. So there will be variances as to what the end state would be. But I think we are at the beginning of the implementation of Basel IV. So you take a few years before we see, I think, what actually is the end result. But in the meantime, I think everybody knows from all these discussions, and everybody who's in the financing market knows that indeed, since last year, credit margin has in fact been squeezed rather than increase in the borrowing costs. Of course, there are various reasons which we have heard across these 2 days. So I would say we have not seen a worsening of borrowing costs for the borrowers, rather the opposite. But we will take some time before we see what indeed plays out from Basel IV.
So in the short term, what do you think is the most immediate impact to this imbalance between the banks?
For now, I think other forces seems to be stronger. The liquidity that we see in the market, the solidity of the borrowers, which have accumulated a very healthy balance sheets over the past few years from the markets. So I think those factors have been playing, are probably going to play a bigger role in the near future. But in the longer run, I mean, by reducing reliance on those internal risk models, the impact should be a higher borrowing cost for borrowers in the long run, all things equal.
Okay. Sebastian, as a European bank here, how do you see the interaction of European lending to ship finance, given the Basel and different countries, different banks taking different approaches at this moment?
Yeah, first of all, as well, thank you for having me. And I think it's really, as TC said, it's kind of leveling some banks a bit more out, some are more active, some are hesitating, so you can really feel that every bank is kind of adapting, and depending, I think in the UK it's starting off next year, in Germany and the rest of Europe it was like more now at the beginning of 2025, and you can really feel each bank kind of having a look, and I think here it's tough to keep up with the competition. I think that's completely clear. That here in Asia, beside the Japanese banks, the other local banks and Taiwanese banks and so on, they are not that strongly bound to this, and that's something where we struggle a bit to be on the same level, but I think that's fair. It's always it cycles there as well as in the shipping industry, and some banks are more active, others not, and then you have to find your spot, your sweet spot, and as Pallavi said, we have to then really be creative in finding the way what we can offer and what product is the right one for the client and add value. And I'm happy for my clients, that the costs didn't went up for them, but they still can now get money for very cheap rates and can invest as well, because that will be necessary for everything we discuss about decarbonization. So at the end, I think, there's not the excuse of, it's so cheap, it's so expensive, we can't do anything. The money is available, liquidity is there, and that will be very, very helpful and necessary to everything we want to achieve together as an industry. So yeah, but for the individual transaction, sometimes it's not easy because competition is strong, and it's a bit different in Asia, in Europe. I think their margins are a little bit higher than here in Asia. That's a fact as well.
Okay, you keep talking about competition and struggling and stuff, but amongst all these banks here on this panel, you are by far the smallest player in Asia with only a few people on the ground. But despite that, and then you throw in decarbonization and Basel IV and the severe competition that you mentioned, what do you think are the success factors of KfW IPEX in this market? How do you originate new maritime transactions in Asia despite all of these struggles?
I think it's very easy. It's all about the people, So you have if you have fewer people, then you have very good and very strong and smart people to find the right access to clients, and then be creative and support them and deliver a service which is at least at the level of the global banks or even better. And that's why they want to work with us. And be really deep into the industry. I think that's something everybody mentioned this during the other panels. You need experience, you have to deal with difficult situations. And if you can prove this, that you have a track record, I think then you're a long-term partner for European, but as well for Asian clients. And that's what they value. And that's why we're happy to have the small but very strong team here in Singapore.
Okay, so basically get the right people on the bus to move along with you. I just want to end off with this part of Basel. Everybody says that the price is all going to go up, but why is the price going down? Oops. Okay, nobody wants to answer.
I can take that.
Okay.
So essentially, like I was saying, there are a couple of factors which go in when you're calculating what is your return on the capital that is employed, right? And one of them is the capital employed itself. If you, so I was mentioning that all banks are using different scorecards at different times, are rating it separately. What they want to do, what Basel 3.1 attempts to do is put everyone on a standardized scorecard. Just getting a little technical, what happens is the LGD floor goes up, which means the residual value of the loan after you consider the collateral value is recovered. The loss given default, which is if there's a default, what's the loss? That itself floor goes up. So higher capital is employed. When a higher capital is employed, it essentially means if you want to keep the same return to the shareholders, you have to increase the pricing. There is no choice on that. So that's why the pricing increase, and which is why the whole capital employed, and this is all from the GFC days, right? It just keeps going on and on over there. But why should everyone be concerned what the bank does is because eventually the bank will have to pass it on to the clients. So either they can pass it on, or they can lend selectively, or they can choose structures in a manner that kind of minimizes this increase. That's it.
Okay. So Basel will have an impact on terms, and then let's move on to decarbonization, because the two topics that we're supposed to talk about in this limited time. So Colin, a year ago you mentioned that SMBC has a roadmap and a playbook as to its approach to net zero, and I quote you say, lenders expect shipping companies to have a clearer decarbonization roadmap in order to secure financing in the future. And so a year on, we're looking at all this competition between the banks. How important is a decarbonization strategy to, when you're looking at a bank, at a ship financing transaction? Is it a nice to have, or is it a must have, or others?
Yeah, thank you, Suen. Hi, this is Colin from SMBC. Yeah, I do hope I remember I said that last year. But I think it's true that for SMBC, we still have the long-term target to achieve net zero by 2050. So that is something that is not specific to maritime, but for the bank, it's something that we strive to achieve. So sustainability and climate risk management, I think, is still something that is important to the bank. So right now, yes, from 1 year ago, we had that playbook, and that is still very much in play today. So for every transaction that we bring to our credit nowadays, it's not only the credit matrix, whether it's the LTV, the residual risk, and all the other kinds of risks that we are managing, but for every transaction, we are required to have a component on that specific asset that we are financing, as well as the counterparty that we are dealing with. So a lot of the clients sitting in the audience here would realize that we do ask them a little bit more questions than the usual risks that we are trying to address with credit. So that is still something very much in play within SMBC. I think that being said, that is a 2050 target. So we are looking at quite a medium to long-term horizon. So in the near term, I wouldn't say decarbonization strategy is a nice to have. I think it's just something that the banks, as well as the whole industry, would have to try to work towards as we try to move towards a medium-term target. I think different companies, different banks, they have different horizons. Some have near-term 2030 targets, some a bit longer term. So all in all, yeah, I think that is still very much a focus for SMBC.
So, I guess everyone has a role to play to build the plumbing system. Angelina, do you agree? In terms of decarbonization, what role does it play when you're looking at a transaction?
Yep. Hi, this is Angelina from Crédit Agricole. So I think decarbonization is not just a topic of conversation. It's already very deeply embedded into the financing frameworks of banks. Most leading banks, including Crédit Agricole, and I think all the banks here are signatory to Poseidon Principles. This means that we are actively measuring the climate alignment of our loan book. And for our ship owners, this means that two things primarily. First of all, there's increased scrutiny of vessel efficiency. And second of all, there will be increased importance placed on sustainability load-linked features. So, for example, there may be margin adjustments that are tied to vessel emission performance. And in future, there may be covenants that are linked, or they will continue to encourage fleet renewal. So I think bank and playing a part will help ship owners to approach ESG not just as a matter of compliance, but as a source of competitiveness as well.
It seems to me that the easiest thing to address decarbonization is to finance a new build. Colin, I think, is that correct? Do you think that might be the only way to address?
I think by and large, intuitively, it does make sense to finance the most technological advanced vessels in the market. I think a lot of us being Poseidon Principle signatory, I think that's what we observe in our yearly reporting as well. I think personally, it's a bit counterintuitive as well, because I think nowadays when you look at a new build, it is a lot more expensive than maybe the same asset type that the owners would have ordered maybe 2, 3, 4 years ago. And I think within SMBC, we rely a lot on the historical data on how we measure certain residual risks and so on. So I think ironically, what we do realize is that for second-hand ships, we could be financing them at a lower leverage. The residual risk may not be as high. So I think yeah, the short answer is yes. I think the easiest way to achieve certain targets or decarbonization strategies is to continue to look for new builds. But I think it has to be a bit mixed in the meantime.
We love to finance retrofits as well.
Yeah, I was going to ask you that. Like, what about the rest of the ships?
So, for sure, it's something which has not been used that much during the last years because liquidity was high and all the ship owners, what they did in terms of retrofit to be more efficient, or it was not that expensive that they needed financing for it. It has been different during 2004 IMO 2020, so we did a lot of retrofit financings for scrubbers, for example, really fleet retrofit financing programs for like 30, 40 vessels, or we did financing for new propellers. That brings a lot of efficiency, and also it's like 1.5 million per vessel, and then you retrofit. It was a big owner, 100 propellers, and then it's a good amount as well to need financing from a bank. And that, I think that will come. It's not tomorrow. I just had a chat with the Everlands colleague who has been on the panel before. The interesting number is that during the lifetime of a vessel, 30% of the CO2 emissions is emitted during the production of the vessel. So I think that's something, when we talk about new builds, we have to take into account as well. So it makes complete sense to make the existing fleet more efficient. And then we were part of financing for some of the LNG retrofits. So really conversions from a normal traditional marine fuel to LNG. That was very expensive and didn't went that well at the beginning. But now these new vessels are all kind of flexible and ready. And at the point in time when the fuels are available, then it will make sense for a part of the fleet to retrofit them. And then that's something we want to do for our clients. And for sure, we like it if they build in the flexibility already now. And then we can take it from there and see at what point in time it makes economical sense. I think that's the part where it has to be sustainable, also from an economic perspective. But it's for a bank, definitely, if you're in Poseidon Principles, it's not, you cannot finance, or it's difficult to finance 15-year-old vessels. Yeah, because you will have all the emissions factored in to your, and then you're not aligned at the end, or you're getting misaligned. So it's just a fact if you're part of Poseidon Principles.
Okay, so we have the new builds, we have the retrofits for those vessels already on the water, but the shipping sector is not, filled up with just big names. There are a lot of smaller names in the market as well, and we kind of have to move together as an industry. What I heard so far is that the banks are getting very selective with their choice of customers. The banks are, typically going after the top-tier names. But what about the smaller to medium-sized companies? Maybe Angelina can take this one. So shipping is not just filled with the bigger tier one name companies. There is a lot of SMEs, owning 20 to 80 vessels, for example. And Crédit Agricole is, I guess, you're very proud to have financed the big names and also the smaller names. Can you maybe share an example of like how you do it? I mean, with decarbonization in the back of your head.
Well, I think 20 to 80 ships is not a small player. I think in this part of the world, there are a lot of small private owners. Although they are small, they can be top-tier names. And I think we are very proud to be continuing financing them. They may not be investing into new ships right now because asset price is high, they're flooded with cash, and they're waiting for the next opportunity. And I think this part of the sector is an important part of the global fleet, and it's important to continue providing capital to them. And I think what is required from banks and from us in particular is to tailor solutions for them. I mean, we can think about more flexibly, we can work with ECA, we can think about portfolio approach. In short, we have to remain flexible, and I think it's important to continue financing those names.
Okay, thank you. So I pause here for a bit because it seems like there's a lot of distractions in today's world, Basel, decarbonization. But my theory is that the industry needs finance. I mean, finance is the lifeblood of any capital-intensive industry like shipping. And today, we see owners with a menu of financing options. There's so many to choose from. I mean, the last session was on alternative capital, and then now we have the bank panel. But, I can see that ship financing banks, they remain committed to shipping finance, but like a Pokemon, they have to evolve with the times, just like how Pokemon evolves to gain new abilities, as my son tells me, and to survive tougher challenges. Banks will also need to continuously adapt to all these changes that's happening in today's market. And Sebastian, yesterday, one of the panelists in one of the panels said that if you still remain in shipping after the GFC in 2008, we are winners. So we are all winners here. And it's also said that Singapore could not have remained a #1 maritime nation for so many years in a row without change. How would you say that the banks have changed in the last 10 years?
It's not only the great financial crisis, it has been, you had then also all the other oil and gas crises. Most of the banks have been in oil and gas as well. Now we had COVID. We have been in the cruise industry for a long time, and I can tell you that was also a very tough cookie to digest, whilst the people in commercial shipping have been like celebrating their high rates, the cruise companies were there without any dollar of revenue. So I think it's, as you said, and that's, I think, true for the companies as well. I think if you think about all the complexity we discussed, the volatility and everything, our clients have to adapt quite quickly, and it's a global industry. I think that's really the, if I compare it, I'm responsible also for aviation and then for land-based transport. Like the land-based part is very, very national, very local, and the global business we are running all together as an ecosystem is evolving all the time. So we are used to this. It's like if you train for a marathon, or if you're like a kind of an athlete, if you're doing this kind of different disciplines, then you're just prepared for what's coming next. And we had tough discussions with our risk management on all these different crises we mentioned. And then you have to take a view, you have to act quickly, you have to take decisions. And then you see what is coming up, it's coming down, and the other way around, and you can go through this. But still, then we have maybe strategic decisions, you have a portfolio which is not well balanced, as for a lot of German banks especially, who were very heavily dependent on shipping and who did not survive this crisis, so they couldn't just equal it out over time, and they couldn't wait so long as we could, for example, as IPEX-Bank. So it's really about acting quickly, and then I think also taking a view, and we also sold parts of our assets, especially during the offshore crisis, because we were not in a position to restructure it in a very good way with all the regulation we had on top. So it was better to give it to other partners who then were in a position to do this in an elegant and good way. So I think it's also, if the shit hits the fan, then you have to really think about what is the right solution for your client, but also for the bank, and then find a way how you handle it. And I think that's what all the banks here on the panel did successfully, and in a lot of cases together. If I looked into Kasib and others, we did a lot of cruise financings together, and I think it was also thanks to the banks and to the ECAs and everything that those global, now again, super players got through this crisis, which was very deep and very hard. So I think it's really then sit down, try to find a solution, and there is not a kind of a way you can do this as the last year or the year before. You really have to be innovative and think what is the right way. So we had in our models maybe a decline of 20% of revenues for a cruise company, but we didn't model in 100%. And that was the case when COVID broke out. So then you have to sit down and think about what's the right step.
Okay, so what I'm hearing is banks are very willing to adapt to change. Banks are very flexible, just like our last panel. But what do you think owners can do as well to evolve with the banks?
I think they can use the whole ecosystem. I think it's very good that we have all these different players with all their strengths and forces. And I think as a CFO in these days, you have to know which source you need for which project. And you have to map your capital sources, your banks, the strengths and the weaknesses, and then choose the right partner for the right project. And I think then that's the way how they have to do it. And then they will be successful in the future. So it has to be consistent in what we do as a strategy. So we should not move around every 3 months with a different, priority and ask them different things. And then those shipping companies can be very successful because they can tap different sources. And times will not always be as sunny and shiny as today. So difficult times will come, and then different players will act differently, and then it's good to be with the right people in the room to find a solution.
Yeah, just on the point of what owners can do, actually, Pallavi and Angelina, you both had the similar view when we discussed. You said that discipline in financing was important and quite a key thing that you think about when you're looking at a deal. And Basel and decarbonization doesn't actually mean less financing. It's just smarter and more disciplined financing. Can you, maybe each of you, give an example of how this has worked in practice when you're looking at your clients who are disciplined in, looking at your balance sheets?
Sure. So obviously the Basel 3.1 has not arrived, but in anticipation, all the processes have moved in that direction. So I want to say that I think what is very critical that banks will get selective with their financing. If we want to do the transaction, we want to, this is a best case scenario, and this is what the banks want, right? So you want to fund to the, to a good credit grade company. You want to have tighter covenants. You want it to be structured well, collateralized well. One very important thing, and which everyone has expressed so far, is similar to what Colin was saying as well. Standard Chartered has its own net zero commitments and are committed to walk on this path. And we very much use lending as a leverage to get there. So from a ship owner's perspective, we are, we've seen proposals, we've seen transactions come to our table where on a transaction basis, it looks fine, but the group does not have a credible transition strategy. This is something that we are aligned with. So we put that, when we are talking about selective financing, that is very much a core criteria. It could be in terms of EXI, CII of the ship itself, the group's strategy, specifically the Poseidon Principles score, etc. But we do look at it from a perspective that there's transparency in terms of what is being done, what are the metrics, are they being reported on time, all of that, to make sure that when we are doing the transaction, and a couple of them have been done, and extending this further to even FPSOs, because we manage the FPSO sector as well, we have continued to support this sector subject to some of these criteria, which meets our, let's say, what we call the transition framework principle. So we use our capital efficiently to make sure that we still are looking at the same returns, but we are deploying our capital effectively in the same strategy that we want to go.
Angelina?
Yeah, I completely agree. I think most of it has been said already. So Basel IV, it will raise the bar for capital efficiency. It means that impact here, it's basically twofold. There will be, we will need to go for more selective deployment of our balance sheet. And it means that we may need to select projects to do and maybe top tier names, and the leverage ratio may be lower. And it means that banks may need to deploy their capital in more selective projects, and we need to be more careful going forward.
Okay. Okay, 5 minutes, right. So 5 minutes, let me see. Okay, maybe TC, you can take this and keep it short, because we have an exciting last part here. So in today's world, when we're looking at bank financing, what do you think is the biggest sort of opportunity and one big challenge from a bank's perspective when you're looking at ship financing? Just very quickly, and then once you've addressed that, what advice would you give to Asian ship owners in this new normal? One big opportunity.
Opportunity,
Yeah.
perhaps still coming back to the environmental issue. Well, recently there has been a collapse in one of the bigger banking alliance, the Net Zero Banking Alliance, due to the exit of some banks from a major country. But so maybe this is an opportunity for us lenders to sort of regroup and refocus on the issue, because I think we can all agree that the environmental issue and also the IMO 2050 net zero target are not going away. So it will be a grind, it will be a long battle. So maybe this is an opportunity, like I said, to refocus, maybe to use the Poseidon Principle platform or to work directly with IMO. But my gut feeling is something has to be done on an organizational basis. Challenge now with very competitive and liquid financing market, I think the challenge is for lenders to say no. What I mean is, it is one thing to compete based just purely on pricing. It is another matter to give in to, I would say, too loose financing structures. For example, leverage, for example, covenants, security. So I would say, yeah, I mean, to normalize loose structures is not good for the industry in the long run. Sorry, the second question was advice. I'm not sure I'm qualified to give advice, but also on the same note, since this is a very favorable lending market for borrowers, it's perhaps a good time, obviously a good time for borrowers to level up for those especially who are very lowly leveraged. For example, if your balance sheet is only 20% debt, it might make sense to make it a bit more efficient, take advantage on the current situation, maybe up to 40-50% to make the capital structure more efficient. That being said, maybe be careful not to be over-reliant on one type of lender, and maybe to diversify also the source of funding with more uncertainty now on the regulatory and the geopolitical risk. Yeah.
I mean, for me, I would say the biggest challenge in today's climate is really, all the ship owners having too much cash, sitting on piles of, if I can call it pandemic cash, paying back their loans. I would say that, for a big challenge for banks is holding on to a shipping portfolio.
Spend it wisely and maintain some in your, balance sheet for the bad times. Maybe that's also good.
Yeah.
Not stream it up through dividends and then it's away.
Yeah, can do that too. But I guess, in this last segment, if I can ask each of you to give the audience an elevator pitch, 30 seconds, no more than that. I will time you. I'm sure Kevin will time you too. 30 seconds elevator pitch on why bank finance remains relevant in today's climate, and how do you distinguish yourself from the rest? Okay, who wants to go first?
I go. Okay. I think you're probably referring to the fact that the earlier session talked about alternative capital, private credit, etc. I think we work, we are complementary to each other. Because private credit or alternative funds don't have the same restrictions that banks have in terms of Basel 3.1, their capital allocation is different. In the past 5-6 years, what we have seen is private credit comes in spaces that, in those gaps that banks are unable to fit in. Banks definitely continue to give a relationship-wide, and I say again that not a transaction-wise support to the clients. So I think the banks absolutely stay relevant. The return expectations from bank and private credit are very, very different. So we are happy to have private credit come in that kind of diversifies the sources of funding for the ship owner itself. But I have no doubt in my mind that banks will continue to be relevant. Sorry, more than 30 seconds.
Okay, who wants to go next? 30 seconds, elevator pitch. Colin?
I can do it very short so
Okay.
that we can regain the seconds. No, it's not a sprint, it's a marathon. I think that's why we need everybody, and that's why we need banks as well. That's very clear, and we have a lot of money available, and that's necessary. Why they should work with us, I think I already said, is about the people. I think that's relationships and experience, knowledge, looking through the cycle. And for our bank in particular, a very stable shareholder with the German government that always helps as well on our side for access to capital.
Thank you.
I think, I think for bank financing, I think it was alluded to earlier that it's still the largest chunk of the capital resource in the industry. I think in this panel, although we call ourselves bank financing to shipping, we hope that it is not only the financing that we are offering the clients. I think it's the variety of products that we help to support the client as well. And then again, the relationship I think has been mentioned a few times. So we do hope that each and every bank down here has their own unique place in certain relationships across the clients. So we do think that, yes, that is the most relevant for bank financing or bank products in general.
Thank you.
I think shipping, as we know, it's global, it's cyclical, and it's capital intensive. I think traditional bank finance will remain relevant because banks are prudent, they're predictable, and they're relationship-driven. We don't just write big tickets. We're here with owners, we stay with owners for the long term, and we ride with them through the cycles. And we are here to commit. So I think it's all important. At Crédit Agricole, we are not just specialists, we are scale player, and we are able to mobilize our balance sheet worldwide. So I think we'll continue to help owners in this part of the world and globally as well.
Thank you.
Well, I think bank debt is still amongst the cheapest form of financing, and also banks can lift big amounts. And for DNB, we are also a full-service provider, from IPOs to bond issues to ECA structures to, of course, bank debt. We are one of the leading players within the maritime space, and we are also a committed lender into the space for a long time, and hopefully for a long time to come.
Okay, you've heard it. Banks remain relevant. Banks are important in this transition. We can't, they are truly relevant in this ecosystem. That's why this conference is called Marine Money. And with that, I'm out of time, and I thank my panelists for an excellent discussion. And thank you, everyone, for staying in this room.
Thank you.